forces, rather than pulling together, it's going to separate. I see these tremendous centrifugal forces, and this is how you separate the heavy material from the light one, you know. The same here. You take the difference between Greece and Germany or other countries, and you will see that it was just papering over the differences when they said we create Euroland and euro as a currency, and the strength of the chain is determined by its strongest link, which is a completely foolish idea. It's just the opposite. Yes?
Sandy, I don't know if you guys read that handout, Is There a Swiss Gold Franc in the Cards? I wrote that. And right now the Swiss Parliament in the fall session is considering adopting a Swiss gold coin, a gold currency. And it's the biggest Swiss party. Now, and of course, because of the tremendous pressure on the Swiss franc, the paper franc, because the euro money is going to the Swiss franc because it's a Swiss franc, it's closer to the gold. And either the Swiss National Bank intervenes again and tries to sell more, and that's a losing game because the euro and the dollar can be printed much faster, or they adapt this. And in a nanosecond, the Swiss paper franc will go back down and the gold will start to rise. And it may take the Swiss to do it, and then the European Union will be obliged to do something as well. So it may not implode internally. Maybe the Swiss will pull the trigger. That's, what was the name of that politician?
Thomas, yeah, he's not a politician. Thomas,
the leader of the party. Anyway, it's in that article.
Yeah.
So that's another possibility.
I said I have the sword, gold, just the paper. But what? Oh,
yep. You made the assumptions that the euro and or the dollar are still there within the next 3 years.
Yeah.
Personally, I think none of them will be there in 3 years. But why do you think that the dollar will be there in 3 years? I mean, when a euro collapse, when an economic bloc like the European Union collapses.
Well, I don't think it will be
within a month.
I don't think it will be there, you know, maybe in 20 or 30 years' time. But 3 years would be a bit too short. I mean, the history of the dollar is quite entrenched in the psyche of the whole world. The dollar is used in transactions that have nothing to do with the United States of America, and it will be used. If you go to any of these sort of villages in the Far East or whatever, they will accept United States dollars.
Yeah.
They won't accept euros.
But when the euro collapses,
yeah,
and the European Union as a whole collapses.
When I say collapse, I don't mean collapse as in it's going to disappear off the face of the earth.
Okay.
What I mean is it's going to lose its purchasing power very quickly against the dollar.
Okay, you just expect a sharp drop, but not an extinction.
No.
Okay.
Yeah.
I think when it comes to extinction of the euro, then the dollar is going to.
And the only reason I think that
paper money will be lost immediately.
I'll just clarify the reason I think that is because if you look at the maturity profile of all European debt versus when European parliaments would ratify a euro bond, in the interim they'll have to monetize everything until you can sell euro bonds. And so when you monetize the amount of debt that's maturing up until they could possibly ratify euro bonds, you come to the many trillions of euros. And if you look at the narrow base of the euro money supply, it's only 4.5–5 trillion euros, something like that. So that's what I'm thinking, is that that interim, before they can ratify anything like a euro bond, will be very painful, sort of in terms of euro's purchasing power.
Yeah,
think that well, we've got two different setups, whereas the European Union currently are trying guarantees and setting up a special fund in Luxembourg, which is being funded only partially, and then which refinances again somewhere at the markets, or maybe the ECB buys it, I don't know. Versus the concept from the Americans that they monetize in the sense of quantitative easing. But as you know, I'm very bearish for the dollar over the next year, but I'm very bullish for it over the next 3 years. So we might see a jump in the euro to 180 and then down, and I'm sticking to that.
Yeah, that's too smart for me.
So, I'm just saying that in the short run,
yeah.
don't you think that what the Europeans are currently doing, they're trying to only guarantee it, and by buying it through a fund, versus the monetization of the Americans?
How can they buy it? The fund only has 400 euros in it or something. I mean, and they said they're not going to increase it.
Then it's got 40 billion and the capacity to lend.
40 billion, that's nothing.
No, it's got the capacity to lend.
Capacity is what?
The capacity to lend.
How much?
750 billion?
Yeah, so that covers what? A tenth of Italy? It doesn't cover enough.
No, but it's just a redistribution. Not in the sense of we print money and we buy bonds.
No, but in the interim, you've got bonds that are expiring.
But it's
what are you going to do? How are you going to pay those?
The fund in Luxembourg is already buying.
Yeah.
It's already buying bonds.
But it's restricted. Its capital is restricted.
Well, it's got 40 billion it was capitalized with 40 billion, I think, as far as I know. But it's got the capacity to borrow 700 up to 750 billion on top. So they can basically.
Who's going to lend?
Yeah.
That's the question.
Who will lend that?
Well, I don't know who does that currently. So as I said before, it might be the ECB who's buying the bonds from the Luxembourg fund. But currently, it's just rather the guarantees and the capacity of the funds to borrow from the markets, not newly printed euros.
Well, if they try and borrow from the market, they'll be paying a hefty price. I mean,
but they've still got their
market's not
anyways,
stupid.
Because they were capitalized. That's the funny thing about it. It's a strange setup. So
okay.
We've got this
mainly backed by Germany and France, and for that reason, they have the capacity about 400 billion with AAA guarantee. So they have a very low yield on the market, and the market's buying those bonds.
So what they're currently trying to achieve is not
Germany, France, and a quill pen.
An average interest rate throughout Europe. So if you would just put Germany in Eurobonds and Greece in Eurobonds, and the average is just the German share of it versus with the current German interest payments, and the Greece with the share of the, well, not the average, but that actually the interest that is to be paid upon the collectivized debt is lower than the one the individuals would pay, and the market is currently buying that.
Rudy wanted to say something.
Well, it seems to me whether you come in this door or that, it's the German and perhaps the French guarantee, and you call it a Eurobond, or you call it a line of credit backed by German cash and wealth. It comes to the same thing, isn't it?
In the end, it comes to the same
thing.
In the end,
yes.
Currently, the markets are buying it. That's the thing about it. Because currently, the average interest rate is not what is Germany is paying compared to that what is Greek paying and all that thrown together, but it's actually lower if it's collectivized. That's the funny thing about it currently.
Yeah, but to capitalize upon that situation remaining in perpetuity would be a bit ignorant, because that's like saying mortgage-backed securities seem to have all of this value, you know, until they don't.
That's why we're saying, because I'm bullish for the euro over the next year, because the Fed is going to continue on monetizing that.
I don't know.
Actually asking for your thought about that.
I just want to interject one thing. Watch the credit default swaps.
Yes.
France's credit default swaps are now where Italy's were a month ago.
Yeah.
That is very sobering, because if France goes from the asset side of this equation to the liability side, It's a whole new ballgame. Meanwhile, as far as all these guarantees for Greek debt, Finland is saying, we'd like collateral. And Greece doesn't have enough collateral to guarantee, that's why they're insolvent, because their assets are less than their liabilities. So I personally think something very violent and very sudden and very catastrophic is going to happen. It's not going to be a continuation of any past trend where you say, well, the dollar's been weakening, the euro's been strengthening. What happens, and this is actually my question, maybe Sandeep, the professor, knows the answer to this. What happens to, let's say you deposit €1,000 in a bank in Denmark, and then Greece were to suddenly default on its euro obligations, declare a new drachma, and all Greek debt is now repriced in drachma, which of course begins to hyperinflate immediately, right? What happens to your bank account deposit in Saxo Bank in Denmark? Does all of a sudden you wake up and now you have two accounts and 25 drachma and €975? I mean, what?
That's stupid enough for them to do it, probably. I don't know.
Or is the bank, I mean, this is obviously this is the problem that Louis was talking yesterday, that you don't have a sovereign bond matching a sovereign currency. You have a sovereign currency and all these different bonds. What happens when one of those bonds officially defaults and is wiped out? What happens to all the banking deposits? Does anybody know the answer? I mean, is this one of those things that's unknowable until it finally happens?
Well, I think, well, that's why I seem to be more bullish on the euro than anyone here. Because the euro today will not be the euro tomorrow. The euro will not be made up of the same countries. I do expect Greece or whoever to go back outside the euro. Therefore, what will be of the eurozone will be stronger. Worth more in US dollars today than last year, or 2 years ago, or 3 years ago, 4 years ago.
It's back on.
But since it came out.
Do this one thing, if Greece wants to leave the euro, then they will definitely try to not do that, because almost all of the bonds are denominated in euros. If they introduce the government, it's going to hyperinflate with the Greece, of course.
And then there's Zimbabwe. Zimbabwe has no debt today.
Yeah, but
You were a funder of the debt in Zimbabwe where you broke, you lost everything. That's extinguishing debt with loss. But, if I was advising Greece, I'd say, get out of the euro.
okay, but the bonds are on the balance sheets of banks.
Yes, that's right. But then we discover what would happen, Then we start seeing what we need to see. I have not too much concern for banks, as you know. So it's very difficult to know what is going to happen because more and more now is determined by central authorities, whether it's the sovereign state or the central bank, and that determines everything at this point because it buys time. Right?
Okay, now I've tried several times to use my sword.
It's a paper sword.
I have come to it. I say, you should see this centrifugal thing that these countries pull apart rather than pull together. And there is a lot of wisdom in what Benjamin Franklin said before the War of Independence against Britain. He said that let's hang together because otherwise we'll hang separately. So this is something like that. I think the euro is going to collapse because these countries will get fed up, like Greece, and Italy, and so on, and say, we'll go our own way, and we manipulate the value of own currency, we manipulate our own interest rates, and we, thank you very much, we had enough of the euro and European cooperation. I think it would be worth to make the effort to save the euro, even though the euro was born in sin, original sin, which was that the Europeans at that time, 12 years ago, should have seen the danger signs all around, and they should have, you know, they put a little bit of gold in the European Central Bank for window dressing. You know, that's so stupid. Rather than make a clear break and say that we have 30 years of evidence that this system is not working and go on to the next. Anyhow, here's the sword, and I cut the Gordian knot, and I say that save the euro by re-establishing the Latin monetary union. So this is all written here, but as much time as I have left, I would like to talk about a little bit on the history. In the year 1865, 4 countries, Belgium, France, Switzerland, got together. Italy, and they, at that time gold coins and silver coins were in circulation, and they standardized the size and the weight and the fineness of their coins, but the individual what's the word for the 2 sides of a coin?
Die.
Obverse and reverse.
Adverse and obverse. Could be individual. The name of the country, even the name of the coin could be different. I mean, Belgium and France had the franc, and Italy had the lira. And later Greece joined, and they called it the drachma, but it was the same. And what they did was they agreed that their coins were interchangeable, just as freely as if a country has paper money, but coins as well, then they are exchangeable. No charge, no bargaining. So this is what they decided, and it was a success, because at one point they had 20 members. The only one non-European country which joined was Venezuela in South America. So this was a success, and its only weakness was that they fixed the price of gold in terms of silver. So in other words, they had gold coins and silver coins, and the smallest, say the standard silver coin was the 1 franc. It was a silver coin comparable in size to the American quarter. And the standard gold coin was the 20 franc piece. So in other words, they fixed the ratio between the value of gold and the value of silver, pretending that the market ratio is stable. But the market ratio wasn't stable, and that undermined the system. And ultimately it was the reason for his downfall. But that could have been avoided if they had the foresight, and they could have said, actually, it's a bimetallic system, but with a variable bimetallic ratio. So I'm suggesting to resurrect the gold 20 franc piece and the silver 1 franc piece, but we cannot call it 1 franc anymore, because we cannot fix the exchange rate between gold and silver. So what I'm suggesting is, because there was 1 franc, 2 francs, and 5 francs. The 5 francs is the biggest silver coin. So all we have to do is rename, and I suggest that they rename the 5 franc piece, just call it a thaler, to give the Germans a little incentive to join, because they never joined the Latin Monetary Union. And if the silver coin will be the German word thaler, which comes from Joachim Stahl, but there were many other thalers too. In this case, we will pick the old 5 franc piece of the Latin Monetary Union and call it 1 thaler. And the exchange rate will vary between the 1 franc or 5 franc and the thaler. It will not be a rigidly fixed rate. Then you have a much stronger system which is not subject to this pulling and pushing because of the change of the relative value of gold and silver. So this is my suggestion. And just to finish the history of this, it worked very, very well. The first weakness showed up in 1871, and the historical background was the Franco-Prussian War, which broke out in, I think, 1870, with a sweeping victory of the Germans, which was Prussia at the time, because Germany as such didn't exist at that time. But the Prussian victory rallied the other German states, principalities, small and some large, like Bavaria was one of the largest, and they didn't need a lot of persuasion to join in an empire under Wilhelm. Was the Kaiser, was the Prussian king?
Bismarck, no?
Okay. Well, Bismarck was the politician, but it became an empire. The German Empire was declared in Versailles, the Palace of Versailles, because of course the Germans were victorious, occupied Paris, including Versailles, and dictated the peace terms, because the French were devastated. They had to chase away their Napoleon III and so on and so forth. But a large, absolutely incredible sum in gold was charged as indemnity. The French had to pay, I think, 1,000 million gold francs. I mean, this was something like 60 times the value of the Alaska Purchase, and some 30 times the value of the Louisiana Purchase. You know, it's probably by far the greatest amount of single payment which was done not by paper or credit, but the French paid ahead of schedule within a year or two. They just raised the money and paid. They didn't want to have this shame that they, which reminded them of the military loss. Anyhow, but that shook the foundations of the Latin monetary union, because the Germans adopted the gold, well, they adopted the gold standard earlier, but with this so much extra gold coming, they demonetized silver, which meant that they were melting coins and selling the silver on the world market, you know. And that started weakening the silver price. And once this bimetallic ratio was broken, silver started falling further. And then, just 2 years later, the United States demonetized silver, another blow. So 2 big blows. The German demonetization of silver and the US demonetization, 2 years apart. It was too much. And the ratio, the gold-silver ratio, which was 15 in the United States, 15.5 in the Latin monetary union, started going up. Going up? Yeah, going up. Meaning that the price of silver was falling, the price of gold was rising. So it fluctuated, but was increasing. The highest was, what was it? 100. But then it fell back to, in 1919, the end of World War I. Silver recovered, and the ratio was something like 16 again. But it didn't last, and at the depth of the depression of the 1930s, it was 100, which meant the price of silver, which by metallic, the fixed price was in dollar terms was $1.29 for an ounce of silver, and that dropped to something like 25 cents, 1/5, which was a tremendous loss of value, and not just value, but liquid value. I mean, this was money, and it's not just like, okay, some stock drops in price in the same rate, but it was the most liquid thing, you know, silver money, on a par with the gold money. So this is a tremendous loss of wealth. And then it meant that the Latin monetary union had to close its mint. It had several, because each country, member country, had a mint. But all these mints had to be closed to silver. Well, that's just an expression to say that the right of people to take silver to the mint and convert it into silver coins at a fixed rate, no charge, no seigniorage charge involved, and unlimited amount of silver. So if they had kept the mint open, it would have been overwhelmed, inundated with silver, because people from all over the world would just bring their silver and demanding coins, but they couldn't handle that. This just broke the bimetallic system, and that saved the Latin monetary union for another quite a few years actually, because it started in 1871, and in 1933, the United States demonetized gold. Britain did the same 2 years earlier. And then the Latin Monetary Union wanted to carry on bravely against these devaluations. And they could carry on for another 3 years. And in 1936,